Assalamualaikum warahmatullahi wabarakatuh. Honorable Mr. Ade Candra SMMM as a lecturer in Financial Management courses. First of all, hello everyone. Let me introduce myself. My name is Melisa Alivia with NPM 224111006. Okay, in this video I will discuss about risk and return. The point definition physical. Risk is the possibility of an event occurring that could affect the achievement of an entity goals. So risk is a situation that is uncertain and there is an element of danger, outcome or consequence that could occur due to ongoing process or future events or individual and organizational activities differently certain risks because they contain an element of uncertainty. The risk can occur because there is no lack of information about things that will happen in this future, whether they are beneficial or detrimental. In the Big Indonesian Dictionary or KBBI, risk is an unpleasant consequence or harmful dangers of an act or action. Okay, next point, definition return. Return is the money earned or lost from investment activities over a period of time. Simply put, return is the profit that investors get from their investment activities. The return obtained can be represented in the form of monetary value or can also be in the form of a percent obtained in a certain time period. The returns that investors get are not always in a positive direction, but can also move in a negative direction. Returns that move in a negative direction mean that the invested capital is experiencing losses. For this reason, a fairly common expression in the world of investment is high risk, high return, which means that when the investment risk is higher, the higher the potential rate or rate of return that an investor will get. Next point, definition risk and return. Risk can be said be an opportunity for loss to occur in terms of investment. The loss is a loss of money. Risk means the possibility of an undesirable outcome occurring or the opposite of the desired one. Meanwhile, the rate of return is the profit that will be obtained or can be interpreted as compensation. In the case of investment, this compensation is obtained from inflation or an increase in the price of goods. Okay, next slide. The relationship between risk and return is as follows. The point, it is linear or unidirectional. The higher the rate of return, the higher the risk. The greater the asset we place in investment decision, the greater in the risk arising from the investment. And then, linear coordinations are only possible in normal market. Okay, next point, investment risk. Investment risk is a condition where investors have the opportunity to experience losses due to the investment activities they undertake. In other words, the return obtained are not in accordance with what was previously expected. Usually, the risk of a product is directly proportional to its returns. Okay. Next point, types of investment risk. A. System risk or systematic risk. Systematic risk is a type of external risk that can be provided for control. This type can affect all effects and cannot be eliminated by diversifications. Interest rate risk. Interest rate is the risk that arise due to an increase in internet rates. Even though interest rates increase, investment profile and the value of interest-bearing bonds will experience a significant decrease and vice versa. Then inflation risk are following is included in systematic risk purchasing power risk, the risk that arise due to inflation. As a result, the cash value of an investment today will not have much value in the future. This has the potential to reduce people's purchasing power due to rising price of goods. And then, currency exchange rate risk or forex. Currency exchange rate risk is a type of investment risk that occurs due to change in foreign exchange rates. This will make the conversion value of foreign currency to rupiah not much expectations, especially if the value falls. Next, types of investment risk B. Unsystematic risk. This risk can be avoided or controlled in the form of an investment portfolio or diversifications. The following is included in unsystematic risk. 1. Liquidity risk. Liquidity risk is the risk that arises due to difficulty providing cash with a certain period of time. Usually, this happens when one party cannot sell its asset because there are few interested parties or they are unable to meet with other parties. 2. Reinvestment risk. Reinvestment risk or reversement risk is the risk that arises when income from an investment asset requires investor to reinvest it. It is very likely that the returns will be lower when reinvesting. And 3. Business risk. Business risk is a type of investment risk. It is closely related to the business of the company in which a person invests. That's why it's very important for investor to know the company profile that one of which is to be sold. Next point, types of investment risks. Currency exchange rate risk. Forex currency exchange rate risk, a type of investment risk that occurs due to change in foreign exchange rates. This will make the conversion value of foreign currency to rupiah not match expansions, especially if the value falls. Commodity risk. Commodity risk in the risk that arises due to change in the price of certain commodities. Usually, this is influenced by other risk factors such as price fluctuation or supply and demands. 5. Country risk. Country risk of political risk is a risk that arises due to change in a country's legal regulations. As a result, yield can decrease or even disappear. Next point, expected return. Expected return in the estimate amount of profit or loss that investor can anticipate from their investment activities. The figure was obtained after analyzing historical data on the rate of return on investment of an asset. Next point, how to calculate expected return. Expected return risk mean free rate plus risk premium information. Expected return, the expected level of return. Risk-free rate, the rate of return on investment in instruments that is almost risk-free. such as the interest rate on deposits or government bonds. This component consists of estimate of the inflation rate and the rate of return on risk-free securities, risk premium, estimate level of risk of an investment. The equation above show that if the estimate risk of an asset or assets per saved risk increases, the expected return value will also increase. Thus, owner of risk asset will get higher returns as compensation for the investor willingness to bear extra risk. Next point, how to calculate expected return. There is an alternative expected return calculated as follows. Information: RF risk-free rate of return, investment beta, aka measure of the volatility or systematic risk of the portfolio, RM, expected market return. This equation sets the change in the estimate return on the risk-free instrument's rate of return depends on the investment beta or volatility. Well guys, that was a little explanation regarding the material I have conveyed. I hope it can be understood well and is useful for all of us. More than less, I apologize for ending. Wassalamualaikum warahmatullahi wabarakatuh.